Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and last week I wrote a story for Switzer Daily where I cashed in on the old Tom Petty song, "Waiting is the hardest part." And sure, we're waiting to be released from lockdowns and closures of the economy and social restrictions, and we're also waiting for the stock market to either have another leg up or another leg down to try and work out what we should do in terms of buying the market. Do we wait and buy, or have we actually missed the first leg up and we should get on board a rising stock market? Let's just see if our experts have changed their mind when it comes to where the stock market's going. First up, we have Julia Lee from Bourbon Invest. Next, BetaShares Chief Economist David Bassanese. Then Charlie Aitken, Paul Rickett and myself will toss around the key issues that will either be sending stocks up or down, and we'll try and name some names. And my final guest is John Lecter, who's the CEO of Cashworks, and anyone who's interested in trying to get the best term deposits out there might be interested in this particular story. Julia, thanks for joining us.
Great to be here, Pete.
Julia, let's start with the big issues first. And lots of people have seen the stock market of ours remarkably come back. Not as much as the Americans, but we certainly have come back. Do you think there's going to be another leg down?
Look, Pete, when volatility usually hits, it's not over in one go. And look, I think that we haven't really seen the true impact of earnings. So for me, it's a little bit of a tug of war between what's happening between, I guess, the stimulus from central banks as well as governments around the globe versus the earnings impact from individual companies. And what's been winning has been the stimulus that we've seen, and it's been quite substantial stimulus. To give you an idea of size, just having a look at the US, we've seen the US in the last 3 weeks buying 1.5 trillion US dollars worth of bonds and indicating that they're going to buy another 2.3 trillion. So that's about 3.8 trillion US dollars. And to give you an idea of size, that's about 19% of the US stock market in terms of size. So that type of money flow needs to go somewhere, and it's probably been finding its way into things like the share market. However, at some point, individuals will have to also look at the earnings impact, and we're starting to get an idea of that during US earnings season. So it's this real tug of war at the moment, and on some instances, the Federal Reserve wins, and then the earnings impact is greater than the stimulus that we see, and then we see the fundamentals sort of winning out. So I think we're in this tug of war, and it really does depend on COVID-19 and whether we do see secondary infections and a second lot of shutdowns after reopenings, or whether we're clear sky.
Yeah, so it seems to me, Julia, the really big test, even though earnings is usually very, very important, because of this coronavirus effect, they will not be treated with the same fear factor as they normally would if the economy was creating these bad earnings numbers. But I totally agree with you in terms of secondary infections. If America goes back to work quicker than people expect, and then secondary infections happen and they have to lock down again, that would be really bad for the stock market, wouldn't it? And earnings going into the next quarter.
Absolutely, and at that heart of this is a health crisis. So, you can't really just throw money at a health crisis and make it go away. You need the health crisis to be resolved first. Having said that, it's a pretty exciting environment to be investing in. I guess for those people who are brave enough, I'd say two things. One is this solvency versus liquidity, and you really want to see companies be able to remain solvent over the next 18 months. So that's one point. And the second is, when you're investing, don't invest on the companies based on what's happening at the moment, but invest in these companies based on what's going to happen in the future. So I guess right now it's pretty tough for a lot of companies, but as long as they can get through this time, try and take at least a 2 to 3 year view in terms of these businesses.
Okay, well, before I talk to some companies that have gone for capital raisings, I know you want to talk about them, just the fact that you brought that up, someone I was asking me about Woodside, is it a buy where it currently is? And I looked at its price in January, it was about $36. Now it's down around 20. I think it was low as 17 when the panic was really on. If someone took a 4-year view on Woodside and said, well, could it get back to $36 in 4 years? that'd be an 80% gain in 4 years and 20% per annum. That'd be really a really big gains for what you might call a quality company in that space. Julia, is that dumb logic?
That's good logic. Woodside Petroleum is really attractive because, look, when you are seeing companies down and out and the cycle probably near the bottom or close to the bottom, then you want to be able to see companies with the balance sheet to be able to take advantage of the situation by buying up assets at cheap prices. And Woodside Petroleum is the company that is in the strongest position in the energy sector to take advantage of this oil price. And it's been an incredible fall in the oil price. Today we saw oil prices trading at the lowest level since 1999. And what we are seeing is, despite the OPEC plus production cuts, the cut from the lack of consumption of oil is really hitting prices severely. In fact, if we have a look at US crude supplies, we've seen overstocking now and a build-up in supplies for 12 consecutive weeks, and some of the major storage units are at capacity. So oil is one of these strange things when you trade. There's actual physical delivery, and if you've got nowhere to put it, then you can't really buy it, and you want to sell it at any price you can. And that's what we're seeing in terms of oil. People just aren't driving their cars as much, and we're certainly not flying at the moment. So that's having a big impact on the demand side of oil. Okay,
now talk to us about the companies that have been going for capital raisings and the impact on their share price, and when you think these companies are a buy, if they're a buy at all.
Look, I think when you look at capital raisings, the general rule of thumb is if you're offered an allocation in the capital raising, it's usually at a highly discounted price to the last traded price. So you usually see a benefit from participating in these things. And of course, if you don't participate as a shareholder, your holdings are diluted. On the other hand, you still have to have a look at this company on the basis of, is it a great investment idea? And if you're not interested in the company, then perhaps you sell off those stocks as soon as they're allocated. And unfortunately, that's really what we've seen today. We've seen an allocation of stocks through recent capital raisings from QBE Insurance, InvoCare, Southern Cross Media, as well as Oil Search. And all of these companies underperformed the market today. We saw QBE down by 3.3%, InvoCare down by 5.1%, Southern Cross Media was down by 9.7%, and Oil Search lost 2.9%. So keep an eye out on those allotment dates. There's a few more later on in the week. Tomorrow we'll see Capital Health being allocated, as well as Electric Optic Systems, and then on Wednesday we'll see Babcock as well as IDP Education. So look, some shareholders probably want to sell as soon as they get a lot of that share, and that selling pressure is causing some short-term weakness in terms of the share price, which means if you take a longer-term view and you are positive on these companies, it can be an opportunity to pick up these shares at cheaper prices.
Is there any one of those that you like?
Look, QBE Insurance, I think, is an interesting one here. It's got an 8 in front of it, which is pretty amazing. It's exiting from some of its more risky investments out there. So, look, I think the insurance space is looking interesting. Look, instead of Oil Search, I probably prefer Woodside Petroleum. But I think Babcock, when it comes up on Wednesday, could also be an interesting one. We're not driving cars at the moment, but there will be a time in the next 12 to 18 months when we're driving our cars on the road and hopefully visiting lots of friends. So that business should bounce back pretty well, given that it's now capitally secured its balance sheet.
Yeah. Rudy Philippek Van Dyke will be very happy you're being positive towards Babcock. He's always been a Babcock man. Finally, I want to talk to you about WiseTech. What's going on there? Is this a buying opportunity, or is it a company we should avoid?
Look, WiseTech's one of those difficult ones. You've seen so many acquisitions through the last few years, and it's about incorporating those acquisitions into the business. So in terms of buying this business for the longer term, I'd probably be cautious. I'd look at WiseTech more as a trading stock because of the amount of volatility that's involved in the business. It's a trader's paradise, but I think it's an investor's headache. So I'd be steering well away from this one.
All right, Julie Lee, is there anything else you'd like to share with us? Because being locked up in that home of yours, just thinking about stocks day in, day out, apart from all the other things you do, what do you think? Is there anything else you'd like to throw in?
Pete, I can't wait to have a drink or a coffee with you. But everyone stay safe. And look, the markets are pretty exciting at the moment, and they can be quite volatile. But usually this volatility does take a bit of time to play out, which is great if you're a trader and trading that short-term volatility, but it can cause some heart palpitations as a longer-term investor.
Julia Lee, thanks for joining us.
Thanks, Pete.
And that was Julia Lee from Berman Invest. And now I want to kick around the key issues around the economy and where the market might be going with David Bassanese, who's the Chief Economist at BetaShares and is a keen watcher of stock markets. Well, it's the right time to talk to David Bassanese, the Chief Economist at BetaShares, about what he's seeing economically speaking, but also market-wise as well, because they are, of course, inextricably connected. But David and I are both facing a curveball we've never faced before. That is, we have to be an expert on a thing called a virus or a pandemic. David, thanks for joining us.
Good to be with you, Peter.
I know I didn't study Pandemics 101. I'm sure you didn't either.
No, not at all. It's you're right. I mean, the past couple of months, we've all been required to learn up about viruses, and this one compared to previous ones. And I guess the big issue is, how is this one different to what we've seen in the past, like with the SARS outbreak and the swine flu, most particularly. Obviously, it's different. It's a widespread. It's easy to catch, and it can be somewhat serious for some people. But there's still a lot unknown about it. I mean, one of the uncertainties is exactly, how many have already had it, how deadly is it really? Still a lot of questions that need to be resolved.
Yeah, and the problem for you and me, being economists who also are very interested in commenting on markets, they're medical issues. Like, we don't know the threat of a second wave if we start embracing the reduction of restrictions, social restrictions, which are all going to be good for the economy and all good for the markets. But if we get a second wave, well, the whole thing could be undone.
Oh, exactly. And when we saw the 1918 Spanish flu, I mean, they did have a second wave. I mean, the scientists do say that at the moment, I mean, again, we've done a lot of testing in a lot of countries, but most countries still have very low. The hope would have been we'd test and we'd find half the population have already had the virus. But that doesn't seem to be the case. I mean, even in Australia, it's still looking at most 5% or so. So definitely herd immunity hasn't been built up, as they say. So, if we do ease off restrictions and we go back to normal quickly, then there is that very great risk of a second wave. So that's why, in terms of the markets, the hopes of a V-shaped recovery, a quick end to this, are probably a little bit over optimistic given those risks.
Yeah, and I guess if we're worrying too much and we go back and the outbreaks aren't as great as we expect, well, the V-shape is a possibility, I guess.
Yes, that or better drug treatments. And we did see some hopeful news last week on one drug in particular. Again, some people have studied that now, and it turns out that, it wasn't a controlled experiment. A lot of the people that were treated with that drug only had moderate symptoms anyway. Most should have recovered. So it's a few question marks, I think, early this week in terms of that big hopeful news on the drug front. But certainly if we do, I mean, what we need is testing, of course. I mean, if we had good testing in place and we're able to immediately identify someone who came down with the virus, quarantine them, trace who they might have got it from, then we can, ease restrictions. And so that's the other hope is that we can get testing in place. In Australia, I think that's the case. The problem is that it seems in the United States, they don't have that testing in place yet. So that's the challenge.
Yeah. But of course, the really big question for people like you and me is, okay, we've seen a nice rebound, and the initial collapse was based on the fact that there was so much uncertainty. We didn't know what governments and central banks were going to do. They've really stepped up to the plate, and therefore we've seen the US market, well, they've rebounded such that they're out of bear market territory. We're still in bear market territory for a variety of reasons, but we're still heading in the right direction. So I guess the key question I want you to be absolutely 100% accurate on, David, is will we see another big leg down?
Look, I think we will see another leg down. I mean, again, the history of bear markets is that you often do get a big, furious so-called bear market rally. This has been like one of the strongest bear market rallies in history, but it's also following the deepest, quickest bear market in history. So the depth of the speed of the rebound has been a little bit surprising, I would say. But again, I don't think it's out of the ordinary in terms of what you do get in the early stages of a bear market. I think the best case scenario is that we will get a decent test of those lows. We'll get another relapse, and I think that will come with the reality that the US economy will only recover gradually. Whether we go through the lows, not sure, but I think there'll be another opportunity to be buying at better levels than where we are at the moment. And I guess one concern I do have is that the US market, if you look at the price to earnings valuations of that market, it's almost back to the peak levels before this whole thing began. Like, we're talking about 18.5 times earnings at a time when we know earnings in the US are going to fall in a big way over the next 3 to 6 months. So that is a very challenging valuation for the market, and it's a lot to expect the markets to sort of look through that weakness over the next 3 to 6 months. They could do it if we do see that V-shaped recovery and or better drug treatments on the horizon, but that is the challenge for the market at the moment.
And I guess the other part of this is, David, we know that Austria, Denmark, Germany and other European countries are trialling going back to work for some parts of their economy. I guess if we really get unbelievably lucky and there is no evidence of second wave, which of course could be unbelievably lucky, then all that stimulus that's been put in the pipeline could really set us up for a fantastic looking 2021, which kind of would then justify the stock market going up rather than going down. And I know this was all predicated on the lucky outcome of no significant second wave problems.
Yeah, I mean, there is a lot of, I look at that stimulus in two ways. I mean, the stimulus we've had is unprecedented, both fiscal and monetary stimulus, but the economic shock we've had is also unprecedented. We're talking about depression conditions. No, let's not mince words. I mean, in the short run, this is a depression. Whether it lasts or not, we're hopeful it won't last. But we're looking at, 15 to 20% unemployment in the US, 10% at least in Australia. So the stimulus is needed to be huge. Now, if we do get that V-shaped recovery, I think, the government, and even the RBA is talking about scaling back some of its bond purchases. So I think central banks at least will, I don't think necessarily the stimulus will stay in the pipeline and lead to a massive blow-off in the markets. The central banks will pull back if the outlook improves. Fiscal stimulus, even in Australia, is very short run. I mean, a lot of the money is pushed into the next few months, as it should be. Obviously, we'll be left with a lot of debt, but the deficit itself will be fair. Well, we'll still have a deficit, but the size of the deficit will contract over the next year or so because that stimulus is largely one-off.
And I guess in many ways, if the economy does rebound faster than expected, well then the stimulus will be automatically pulled back because people won't need JobKeeper payments because businesses are back, doing well. Or, I know, all optimistic scenarios, but the bottom line is, and you used it earlier, the history of bear markets are that there is a bear market rally, then there's a pullback. But to make a bold claim on whether we have to go to, say, a 50% fall in the stock market, which some people are saying because historically that's been the case, I then say to those people, that's true, but in my lifetime, I don't think ever, governments and central banks have never responded so quickly, David, have they? No,
and again, I guess two distinguishing characteristics of this is an undeserved downturn in the way that, I think Jerome Powell, the US Fed chair, has said, when we had the GFC, it was banks, did silly things, they got over leveraged, and there was a lot of reluctance to bail out the banks. Whereas this time, if companies are falling on hard times, you can't really blame them because it's this one-off shock. So there's the stimulus has been a lot more forthcoming. The other, I guess, aspect in terms of the US is the technology sector. Funnily enough, it's the lead sector in the bull market. And it's also been the sector least negatively affected by the shutdowns, thinking about Amazon, Netflix, Google, all that online sort of activity. So that's been helping that market in particular and, helping, and I think going through that big chunks of the US economy at least, unfortunately not the Australian economy, do I wouldn't say benefit, but are at least negatively affected to the extent we're sort of working from home and social distancing and whatnot. Yeah.
All right, so as economists, you and I are quite unique in the sense that I have a product that's on the stock market, namely Switzer Dividend Growth Fund. And of course, you work for a company that has a very interesting product called Bear. Are you long Bear at the moment? Long Bear, a shorting of the market type product?
Look, I think Bear has been, extensively used. I mean, it's a product. You got to be careful with those bear funds, as I said, because of the nature of bear markets. Is you can get very sharp rebounds, as we've just seen. So it's definitely, if you want to take a tactical position on the market, it's there. So if you think the market rebound we've seen to date has gone too far, and we are going to maybe not go through the lows, but at least have a decent correction, then Bear is, definitely a product one can use. But I'd just be, in all things, be very cautious about how much you've invested in it. Make sure you've got, stop losses, positions to get out. It's certainly, you're effectively shorting the market by using Bear, and so that requires an extra level of diligence and care compared to going long a product, because at the end of the day, the share market, as you and I know, Peter, trends up. So if you buy something and it's too early, at least in the very long run, you're probably, it'll come back. With Bear, the market is going to be down, but it won't be down forever.
David, thanks for joining us.
No worries, Peter.
That's David Bassanese from Beta Shares. And now it's time to catch up with Paul Rickard from the Switzer Report and Charlie Aiken from Aiken Investment Management. And we'll toss around the issues that we think are really important right now about where the stock market's going, and we'll have a crack at trying to tip some pretty good stocks. Well, it's that time where I catch up with Paul Rickard from the Switzer Report and Charlie Aiken from Aiken Investment Management to see if they've changed their mind when it comes to will there be another leg down, or is this the start of something really good in terms of stocks? Charlie, Paul, thanks for coming on the program. Good to see you.
Peter.
You notice that we are socially distanced, 1.5 metres or thereabouts. Now, Paul, Charlie, let's kick off with you. It's been a great rise for the stock market, particularly in America, but do you think there's going to be another leg down?
Well, I've got to say the bounce has been violent and probably a bit higher than I thought. I mean, the main market we invest in is the NASDAQ market, large cap tech stocks. Yeah. NASDAQ's now up for the calendar year, which is actually quite hard to believe. Microsoft, our biggest investment, is I think $7 off its all-time high.
Well, it does own Skype, but we're all Skyping or Zooming nowadays.
I agree with all that, but I'm of the view that the bounce has done enough in the short term, and I'm going to raise a little bit of cash this week, just in some of those larger tech stocks.
Will you sell off cash?
I will sell a little bit of Microsoft, sell a little bit of Facebook. I'll still keep my holdings, but just raise a little bit of cash, because I think the risk-reward here is not as good as it was, obviously, 3 weeks ago. And we've got a reporting season in America starting here as well, and these companies will give you some clarity on exactly what has happened and what they think will happen. So I think it's time for just a little bit of a pause in this rally.
Paul?
Yeah, I'm with Charlie on that, Peter. I mean, I thought we'd work around this. Coming back to the Australian market, we're obviously just following the US, but we're underperforming quite badly. I think you said, wrote some figures today that the US market only needs to go up 15% back to an overall all-time high, whereas the Australian market needs to go up, I think, 23% we still need to make up. So we've underperformed about 8%. In a relative basis. It looks like I think we're going to continue to underperform, Peter. A bit of nervousness. And I think there's lots of capital raising. So I think I thought it would work about 5,000. It's actually gone higher than 5,000, almost to 5.5, back a bit today. I'm guessing we've got more work to do in the low 5,000.
I think that's interesting. If you think of the composition of the ASX 200, remember the heavyweight banks are still holding us back a little bit. Energy's still a pretty big weighting as well, and obviously the oil price this afternoon is $14 or something. I've never dreamt that would happen. But the composition of the US market is a little bit different, much more tech heavy, a little less consumer facing. I think that can be explained, and there's been less capital raisings in America as well, because the Fed's standing there providing almost debt capital to companies in the background. So probably can explain that underperformance a little bit, but it's also the capital raising bit, which is a bit hard to swallow in Australia.
Do fund managers look at what we've seen, an aggressive fall of the stock market, then a surprisingly strong bounce back? Do they start saying to themselves, well, look, maybe there's going to be another fall coming. It doesn't necessarily have to be worse than the initial fall. That's why I'm interested. Like some people say, the GFC was a 50% fall. Do you think this current bear market which is now not a bear market in the USA, will it drop like the GFC to a 50%?
No, because I think the Fed and governments globally have moved extremely quickly.
Okay.
They're all in. The Fed is...
I've never seen governments move so quickly.
There is an all-in card being played here by central banks and government fiscally, which I think has bought us a little bit of time. I personally do not think markets will go back to their lows of March. They may pull back 10 or 15% from here. It can happen, just on the reality of earnings and how long this is going to take.
And you've got a bad piece of news, say second wave infections in the UK and the USA.
Maybe.
That would hurt
But just remember that the movement by central banks is unprecedented. You know, the Fed's actually got programs that didn't even have in the GFC in terms of direct lending to municipalities, direct lending to corporates, effectively. This is really quite amazing.
They're even lending to bookmakers, aren't they?
Well, probably. But look, I think you need to put it in context. Have the markets had probably a little bit overdone bounce? Yes. But on the other side of this equation, if we can get through COVID-19, the settings are so aggressive on the fiscal side and the monetary policy side. There is unprecedented liquidity being pumped for an unprecedented problem.
Paul, what do you think? Do you think there's going to be a sell-off in the buying opportunity?
I think we're due for a bit of a pullback, Peter. I'm probably with Charlie. I think the difference between this and the GFC is our first wave was so quick and so steep. Now, if you go back to the GFC, the bottom of the GFC wasn't the start. It was actually well into it post Lehman's. It was actually late 2008, early. I think about February 2009 was probably the worst. Yeah. So that took a long time to play out. Our market had such a savage sell-off, with the virus, because it just came out of, well, I won't say left field, but no one expected it. So it was the total...
The speed was amazing.
The speed was amazing.
We went from all-time highs on Wall Street to a 38% correction, I think, in 3 weeks.
Yeah, and now we're back. We've had a 30% bull rally in the space on Wall Street, in the space of a couple of weeks almost. So you just don't see that. So I think we will get to a period of less volatility, but I think maybe a bit more of a pullback is needed. Locally, I think also, you raised a question about fund managers. Look, there's lots of things to invest in, Peter. We've had 16 out of the top 200 companies now have got a capital raising in progress. There's another score of companies.
You wrote about this in the Switch report last week.
Yep, so. Another score of companies, little companies have done raising. So there's lots of money, opportunities for fund managers to put cash to work. Plus, the other thing that a lot of the super managers are worried about, Peter, are the withdrawals. So. There's a bit of, there's some challenge for the managers. If anything, I think a lot of the support to this market from some of the data coming out of CommSec has been retail investors. That's where a lot of the cash has come from.
Yeah, I think the super funds are nervously positioned for redemption.
Yeah, so I don't think, I think it needs, with our Aussie dollar going up, maybe it's less attractive offshore. So I think there's probably a bit more of a pullback for our market due to that. But I don't think we're going to see a second wave.
The Aussie dollar going up has actually partly been to do with super funds redeeming international investments to get cash ready to pay out for the $10,000 that everyone's going to take out. So there's been a bit of Aussie dollar demand from our own super funds bringing back international investments, which have gone quite well for them, obviously.
Yeah. But on that point then, Charlie, you said you're going to hold some cash. If there is a sell-off, let's imagine there's a 10% sell-off somewhere along the line for some sort of trigger, what will you be buying again?
Only the very best things you can get your hands on. The absolute dominant industry company you can own. Great balance sheets, the same as usual, but just hopefully a little bit cheaper.
No names. The people
it's the same things. It is the Microsofts and Amazons and Googles of the world, but I'm interested in buying some out of favour things. I'm currently looking through some of the travel stocks, some of the entertainers. No, actually globally, things like Booking.com, Amadeus, the booking systems. Thinking that it probably can't get too much worse than here for airline travel. I've had a look at Boeing again, things like that,
That's interesting. But Boeing has rallied a long way, hasn't it?
Well, it's fallen a huge way and then rallied a bit. But we've got a bit of time to do this, gentlemen, is my view. Yeah. I think Charlie Munger was quoted over the weekend saying like the economy it's frozen, and that him and Buffett weren't in a hurry, and they've got $100 billion of cash as well. And when guys like that who have great insight into so many businesses they own, they get daily P&Ls out of a lot of the businesses they own. If they're just saying they're just taking their time, well, I'm happy to take my time a little bit too. But the real value will be in, the real value will be in some of these beaten up deep cyclicals at some stage. But I'm just keeping it to what I consider structural growth stocks that are not that cyclical at the moment.
Yeah, Paul, dividend stocks, because the banks in particular have virtually been told to cut their dividends. What's going to happen?
Yeah, well, look, I think it's going to be really important what ANZ does. They're the first of the major banks to report, and I think bankers are pretty conservative. I'm a banker, Peter. We tend to follow one another, and if ANZ has the I can't say the word I was going to say, But if they...
What were you going to say?
So that's TV, Peter. But if ANZ goes ahead and pays a partial dividend, I think the others will follow suit. Yeah. I think if ANZ says, no, we're going to hold it back, which is what Gonski alluded to.
You're suggesting they wouldn't pay a dividend?
No, I think they're probably still going to pay, but I think if the first bank, and they're the first to come out, if they hold it back and say, no, we're going to be conservative, we still think this is going to be in shareholders' long-term interest, not to pay it now to make sure we've got lots of capital. If they choose not to, I think it's going to be very hard for the other two to pay a dividend. So we'll see what the ANZ does, and then I think that'll set the tone.
Okay. Is there any stock that you'd like to talk about before we wrap up?
Look, I'm a bit like Charlie. I'm sticking with the quality end. I don't think this is a buy level. I think for retail investors, there's lots of share purchase plans out there. There are lots of ways you can spend your cash. There will be more capital raisings, Peter. I mean, the market...
You say buy after capital
I just say investment bankers can smell a fee, right? And they're really good at it.
Yeah, but I think that's good advice. And good entry points, a lot of these capital raisings.
Yeah. And generally, there will be more. So I think if you've got time with your cash to invest at the moment, I think you can afford to be a little bit patient and just sit back a little bit. Just take some time in this market.
And I ran this by Julia Lee earlier. I looked at a company like Woodside, for example. In January this year, it was a $36 stock. Yep. Today, it's around $20. Now, if you gave us 4 years for it to get back to $36, that'd still be 80% over 4 years. Is Woodside a bad investment for a 4-year investor?
Well, I think their dividend's unsustainable. Their payout ratio is way too high, and whatever dividend yield people are looking at is incorrect with oil at $14 and liquefied natural gas at $2 a BTU.
Yeah, but it was capital gain.
No, I'm a no on Woodside. I cannot believe where the oil price is at the moment.
But 4 years, Charlie.
4 years. I'll own Microsoft out of Woodside. Yeah. I think I can accurately predict that.
I prefer BHP to Woodside, Peter. I think, if anything, if you're looking in the resources part of the market, I think BHP and Rio still look pretty good. Yeah. I mean, iron ore is doing remarkably. I can't understand why it's in the $80s.
Well, maybe the Chinese comeback is actually there.
I mean, they're cashed up. They don't need to raise capital. There are two companies that won't be raising capital. And I think...
I'm with Paul on that. I think BHP, as we've always discussed here, is like a diversified ETF over resources is probably your safest way. I'm not so sure about iron ore either. It seems to be defying all logic. Yeah, and so I'd probably leave that just a touch alone. But look, my main point is, Pete, the markets have bounced a lot. You can be patient. Just wait for your moments, whether it's capital raisings or an opportunity the broader market gives you. I don't believe this period of volatility has ended. There will be more.
And we'll end on that. That's Charlie Aitken from Aitken Investment Management and Paul Rickard from the Switzer Report. Now, joining me now is the CEO of Cashworks, John Lechty. Thanks for coming on, John.
Thanks, Peter. Yeah, all good.
Look, I think a lot of people have heard of Cashworks, not quite sure exactly what you do. So just explain it to us in a nutshell.
Look, it's an online cash portal where investors can go along and check out the best rates, and they can choose which particular bank, or ADI as we call it, they'd like to invest with. But a key point of difference is that once you've been onboarded or you've signed up with Cashworks, then you can actually invest in any one of those banks, and we've got 52 on the platform now. You can invest with any one of them without having to redo the paperwork.
And how onerous is the paperwork? I know my financial planners here tell me there's often a lot of delays and all that sort of stuff involved. Is it the same applies when you're doing it as an individual?
Unfortunately. Well, actually, as an individual, it's not that hard. You really just need an ID of some kind, and that needs to be verified. Once upon a time, you'd go to, dare I say, a chemist or a pharmacist or a post office. But these days, you sure wouldn't go to a chemist, but you might go to a post office to get that done. But we're actually getting a number of customers coming on board now who have had it verified, their identification verified by their accountant or their financial planner.
Yeah, okay. So what makes Cashworks really useful?
I'd say the key point of differentiation in the term deposit space is that we don't touch the money at all, is the way we like to describe it. So we set up a Peter Switzer account with the NAB, or rather you've got one with the NAB, you bank with the NAB now, let's just say. And if you choose to pick another bank like the ANZ that you'd rather use their rates, we'd rather get their rates, we will set up an account with them. So the money's really going from Peter Switzer NAB account to Peter Switzer ANZ bank account. There's no touching. And that is a point of difference to some of our competition, where the money does have to go through the broker, the term deposit broker, which we are.
Okay, how do you get rewarded?
Well, interestingly, at the moment, rates have actually been going up significantly in the term deposit space since this mess started, this pandemic mess has started. So the cash rate, inverted commas, RBA cash rate went from 0.75 to 0.25, but we're seeing the biggest borrowers in the country paying well in excess of that. And certainly when you go out past 90 days into sort of 100 to 180 days, in that sort of area, rates have gone up significantly. You can earn over 2% for a government guaranteed ADI, but even in the high ones for the biggest borrowers.
But as I say, but how does Cashworks get a clip of the ticket?
Oh, I'm sorry, how do we get rewarded?
Yeah,
I thought you meant how do the investors get rewarded? The banks, the ADIs pay us a fee. So the rate that you see on our system is the rate that you get.
Yeah, and the beauty of having it on one platform is that you can see it all in one go, and you can make your own choice about how you want to move from one to the other, and you guys, basically try and make it seamless.
Well, yeah, and particularly for platforms like financial planners and so, yes, the onboarding process is onerous, but that's just the law. It's not, that's not a choice that we make. It is a bit of a pain, and we've actually got a way where people can do it without having to go outside their house. They can work from home. But once you've done that, that's it. You don't have to do it ever again. You can just literally look for the best rate and say, I've decided to go with that bank, and we'll do the rest.
Yeah. Do you go with non-banks as well?
If they're approved deposit-taking institution, an ADI, then we do.
So that means that all the products on your website will come with government guarantee up to 250,000.
Exactly right, up to 250,000. Yeah. Okay. So we've definitely got some investors that are saying that I've got $2 million, split it up and give me a government guarantee. The alternative is to go with one of the bigger banks, but you'll get a lower rate.
Yeah,
the banks will pay you a higher rate.
Okay, so how has COVID-19 affected the business?
Look, it's in a working environment space, it's fine. People are working from home, and we're having meetings like you'd normally have in a room, and maybe less coffee and less cheese and biscuits and things, but we're all working in that regard fine. What we're working on for the customers is, as I said, to be able to get people to be able to onboard without having to go outside and go externally. That's important these days.
Yeah, you made the point that rates on term deposits have been rising, and I can remember after the first stimulus package was mentioned, I think CBA took their term deposit rate to 1.7% or something like that. And I remember, gee, that's a big turnaround, and I guess it's part of what the government wants the banks to do. So I guess there's a lot more choice on the website now than there was. I know you've always had 56 lenders, but there's more variation in those term deposit rates.
Well, what I'd say is you've probably seen better rates from those better names. So before we'd be able to sit there and say, well, it's 2%, 2.5% from 50 of our banks. But the ones that you want to do large deposits with were always way lower, whereas they're catching up. And Macquarie came out just the other day at 2.6. Don't hang me on the number, but something like that. It's a big rate when cash rate's 0.25%.
Yeah, most definitely. How do you see the course of term deposits over the next year or so? Well, I know it's a guess, but at least you're in the space, so your guess should count for more than people who aren't in the space.
Maybe. Look, I don't want to throw you back another question, but how do you see the dividend investors investing going forward? Because there's certainly some question marks over dividends, the dividend stocks, and also for bank hybrids, which of course the coupon payment on a bank hybrid is a dividend. Now, bank hybrids have to be paid out in full, or the company is not allowed to issue a dividend to its shareholders. So there's some protection there, but there's definitely some nervousness around. And while you're seeing term deposit rates going up relatively, and the dividend returns likely to come under pressure, I think you're going to see some investors looking to sort of share their portfolios across both. We've certainly seen that in recent times.
So what you're saying is that if someone had, say, 5% exposure to term deposits a year ago because the rates were so low, you might find them allocating 10 or 15% because they become relatively more attractive at a time when dividends from banks are likely to fall.
I know you and I have had this conversation in the past, Peter, but look, it depends on your risk appetite. And at the risk of sounding ageist, the older you are, typically the lower the risk appetite you've got. Not always. My father-in-law was definitely one that was not so inclined. But anyways, not always. But typically, the older you get, the less risk you want to take. So maybe you're saying, well, I've got this much more of my money in the equity market chasing dividends. I'm going to reduce that down and increase my exposure to term deposits.
Okay, so what do you think is going to happen over the next 6 to 12 months with the Cashworks business?
We're definitely going to open a bond offering. I think there's still space in the Australian market for a corporate bond offering that gives investors a wide range of securities to choose from. So in our conversation a moment ago, we were just talking about people going out of dividend stocks into term deposits. Well, there's a space in between there, where it'd be corporate bonds, or at the moment, I believe the flavour of the month is covered bonds. International bonds if you've got exposure into other currencies. So that's our plan. We're going to reinvigorate our bond offering within Cashworks with a lot of new hires and a new custodial approach, and very much an open architecture plan, so that not only will investors be able to invest with us easily, but they'll be able to get full transparency on the pricing and the valuation. And also, we'll have our platform open to other players who want to be able to transact with our clients.
Okay, so give us an idea of what you see as being the perfect kind of bond product to appeal to a lot of people who currently might be oscillating between term deposits and dividends from stocks. What would that corporate bond product look like?
The word in my mouth is depends. I don't want to say that. I'm going to say to you that if it's a large company that's issuing a corporate bond in Australia, then people will feel comfortable with that company. One of the most popular issuers of corporate bonds in recent years has been Qantas. Well, maybe these days they're less comfortable with that. But if it's the large company with the right sort of rating and the right corporate profile, then I think that's a good filler. Because, of course, they're investing in corporates in the stock market. So they're just investing in corporates at a different part of the capital structure. If uncomfortable with what the offering is in Australia, then they might look at some of these covered bonds where there's actually some security underneath there as well, and they'll get rated separately. That could well be the stopgap.
But will you be looking at, because these corporate bonds don't make it easy for people with smaller amounts, will you be pooling people's money together so you can effectively access corporate bonds for them?
We won't be pooling money, but we'll definitely be offering small parcel bonds. So I think that's what you meant. We'll be able to, so someone could walk along with, hundreds of thousands and then put them into, 5 times 50,000, whatever the split is, and get some diversification across their own portfolio.
Okay, well, I think a lot of people would like to see that. So, John, thanks for joining us, and let's hope this damn coronavirus gets out of the way ASAP.
Well, I've been running this company now for just shy of a month, and I'm yet to meet a single person in the company. So I'm certainly looking forward to the day that I can actually go and see them in person. So
okay, well, make sure you send out an alert that you're on the Switzer program. They can get an idea of what you like.
Good stuff. Thanks for your time, Peter. I appreciate it. Bye-bye.
Good to see you, mate. Bye-bye.
You too. Bye now.
That's the show for this week. Thanks for joining us. Let's keep our fingers crossed that our experts are on the money.